right, moving along. 3 more Greeks here. The third one is delta. You're probably familiar with delta. I know Jim talks about delta a lot, and it's on the US chart website. The definition of a delta is a measure of how an option's value changes with respect to a change in the price of the underlying contract. So this helps us understand the speed of an option. And you can see the delta right on our quote board here. If we go back to that 90 even call, it has a delta of 41.20. You'll notice that the in-the-money options are above 50%. If you go as high, I have 87 here on my option board snapshot. It gets as high as 83.58. So that, to put that in a relationship that you understand, 50% delta is equal to 50% of one futures contract. So to state that simpler, 1 delta is equal to 1 futures contract. So you can see if you were holding the 87 put option, your delta is not even 1 yet. You have to be way in the money for a delta of 1. That means that that contract is acting like a futures contract. It's trading at the same speed. At the money, you only have a delta of 50%. So if you want to set up a delta neutral position, you would have to purchase 2 calls at 98. You'd even be a little short with delta at 41.20. You'd be at 82.40. So 3 calls actually to have a delta neutral position with the underlying futures contract. So delta is important in trades like a strangle, where you want your call and your put. We did this in the trade example. If a trader wants to put on a strangle and he wants the speed of both options to be about the same when he puts it on, you look at delta. Now delta is going to change. So there's something we can look at to help understand when delta is changing. That's our gamma. The gamma is the measure of how fast an option changes its directional characteristics. So the gamma is based on the delta. And it's actually read as expressed in deltas gained or lost per point. You can take a look at our option board, that 98 even call. It has a gamma of 7.27. That's how we read it. And also take a look at this later. Go back and look at the different deltas and gammas and thetas as it relates to options in the money, out of the money. But you'll notice here, near the money, the gammas are higher on both the call and put side. And as you get farther away, the gammas start to shrink. It's kind of like a bell curve. So that tells you at the money, near the money, there's a higher degree or a higher probability that those options are going to be moving. And your delta is going to be increasing, decreasing. We talked about this in Vegas. Cover your gamma risk. There's the gamma. If you have a higher gamma, again, you have that higher degree of risk. If you're close to expiration on your strangle and you're reading that gamma is high, that means that potentially the delta is going to change, which means the theoretical value is going to change. Take off that position if you can. That's covering your gamma. And I mentioned how directional risk is important. So this is an important measure, as I just mentioned with your strangle position. If you're writing options, you're capping your profit potential, but you have that unlimited risk factor. Protect yourself. Look at your gamma. Cover your gamma if you have to. And our last one that we will cover today is theta. Theta is the rate at which an option loses value as time passes. Or an easier way to say it is the time decay factor. So if we go back to an option board and we look at that 98 call, we have a theta, I read that as 2.37. So it's going to lose 2.37 points per day until option expiration. That's obviously going to change. Again, we saw our chart time value. It really increases when you get closer to expiration. But I know over the weekend that since the market's closed, I'm going to lose at least 4 points from where it closed on Friday. So theta is expressed in points lost per day, including weekends, all else being equal, meaning futures staying the same.
This material is conveyed as a solicitation for entering into a derivatives transaction. This material has been prepared by a Daniels trading broker who provides research market commentary and trade recommendations as part of his or her solicitation for accounts and solicitation for trades. Daniels Trading, its principals, brokers, and employees may trade in derivatives for their own accounts or for the accounts of others. Due to various factors such as risk tolerance, margin requirements, trading objectives, short-term versus long-term strategies, technical versus fundamental market analysis, and other factors, such trading may result in the initiation or liquidation of positions that are different from or contrary to the opinions and recommendations contained therein. Past performance is not necessarily indicative of future performance. The risk of loss in trading futures contracts or commodity options can be substantial, and therefore investors should understand the risks involved in taking leveraged positions and must assume responsibility for the risks associated with such investments and for their results. You should carefully consider whether such trading is suitable for you in light of your circumstances and financial resources. You should read the risk disclosure accessed at www.danielstrading.com. Daniels Trading is not affiliated with, nor does it endorse any trading system, newsletter, or similar service. Daniels Trading does not guarantee or verify any performance claims made by such systems or services. When investing in the purchasing of options, you may lose all of the money you invested. When selling options, you may lose more than the funds you invested.